Hello everyone, this is Terry with Futuresio, and as always, I would like to thank you for joining us today. It's my pleasure to welcome Michael Gough from the Small Exchange and Dave Force from DTN for today's webinar, Markets That Make Sense. Throughout the webinar, if you have a question, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futuresio. And now, without further delay, I'll hand it over to Dave, and you'll get the pop-up to share your screen again. All right, looking good. She's all yours.
All right. Well, thank you, Terry. And thanks everyone for attending today's webinar where we'll be featuring the new Small Exchange. A big thank you to Big Mike and Futuresio for allowing us this time today. I'm Dave Force. I started here with DTN in 1993. I've done several of these webinars, so many of you already know the DTN story. So real briefly, for those that don't, we started in the early 80s with grain quotes to local farmers. Today, most every farmer and farm-related business receives ag data from DTN. Our DTN Weather Division is the largest weather forecaster in the world. We aggregate more data from more locations than the National Weather Service. We've recently purchased the two largest private weather companies in Europe and Australia. Our third division, DTN Energy, manages 80% of the refined fuel supply chain, pricing, and billing transactions in North America. And our fourth division, Financial Analytics, has the DTN IQ Feed Market Data Service, where we've recently added the Small Exchange data. So I'll be sending you over to Michael Gough with the Small Exchange in just a couple minutes. But first, I do want to bring to your attention the link at the top of this slide. This IQ Feed free trial sign-up link takes you to a website that's normally reserved for Futuresio Elite members. However, anyone watching the webinar today can use this link. When using the special link to sign up for the DTN IQ Feed Market Data Service, the length of the free trial period doubles, and the price is cut in half for new users for the first 3 months. If you have any questions or need any help signing up, contact me. This link, my phone number, and my email, which is dave.force@dtn.com. Again, that's dave.force, my name, @dtn.com, will be displayed on the last slide of the webinar. I want to welcome all the Futuresio members and other guests, and I want to mention that Futuresio is the best futures trading community on the planet. Well over 100,000 members. Many are current subscribers to the DTN IQ Feed. The DTN IQ Feed Market Data Service includes real-time and historical stock and futures quotes, options, mutual fund pricing, Forex data, news, analysis, and recently we've added the new Small Exchange data. The IQ Feed data is sent over the internet to your personal computer, where you can choose to feed it into one of over 100 popular off-the-shelf third-party charting and technical analysis software programs. Or if you're a software developer, you can use our API and write your own custom program. Many professionals are using IQ Feed data in their businesses while working from their offices. They can rely on IQ Feed because it gives them true, tick-by-tick, completely unfiltered data, so they see every trade the exchange sends out in real time. Without IQ Feed, up to half the trade data could be missing. However, most of the thousands of IQ Feed users are not professionals making million-dollar trades. They're actually individuals, non-professional traders trading from their offices in their homes. This home office can be anywhere in the world, as long as you have a good internet connection. And weather permitting, doesn't even have to be indoors. You can receive the same quality IQ Feed data while sitting in your backyard on the patio. Knowing that IQ Feed does not use third-party data, you can be confident that your data is fast, clean, and complete. So whether you're trading 30 feet from your back door or hundreds of miles from home, you can trade confidently with IQ Feed data. Traders have relied on IQ Feed for over 30 years, and we want to keep it that way. So we've built dual ticker plants with quadruple redundancy, and our data centers are manned 24/7, 365. As part of our ongoing commitment to provide traders with quality tools they can use, we've recently added the data from the Small Exchange. Here to tell you more about the Small Exchange is their business development manager, Michael Gough. Michael?
Good morning, good afternoon, good evening, wherever you are in the world. I want to thank you guys for joining today. As Dave mentioned, my name is Michael Gough. I work on the business and product development teams here at the Small Exchange, and I'm very excited today to share with you a project that we've been working on for several years, and I think is really going to change the way you engage with markets. And before I start, I do want to give a huge thanks to Dave and the whole DTN team. They've been a tremendous partner of the Small Exchange. We disseminate our market data at zero cost, and they have been kind enough to fulfill that promise as well in delivering Small Exchange data. And another huge thanks to Big Mike and Terry at Futuresio for putting together such an incredible community of traders. You guys all know that it's difficult to trade alone. It's so helpful to have a community you can bounce off ideas and talk about signals, etc. And I've been a long time reader. I'm very excited to be a first-time presenter today. So thank you again for joining me. Let's get right into it. So at the Small Exchange, we are a brand new futures exchange. And our goal here is to make futures markets more accessible to more people. Now you may be thinking, why tackle futures? Well, in our view, futures have such great advantages exclusive to them, but it's almost as if every advantage comes with a drawback to the retail trader. It's currently this world of this or that, give or take. And this is because traditional futures were not constructed with the retail trader in mind. So before diving into how the Small Exchange is fixing this problem, I want to take a moment to look at some of the pros and cons of the futures of old. So compared to stocks and ETFs, futures are more economical, but they're also more unwieldy. You may be thinking, what does that mean? Well, every product you're able to trade comes with a capital requirement and a size. Now, if you've lived primarily in the world of stocks and ETFs, then you're used to paying either half or all of the product size and capital requirements. And that efficiency that's so often talked about in futures comes from its smaller capital requirements, which means you have to put up just a fraction of the product size to trade it. But what about that product size? Well, traditional futures were made for large institutions, which means you're stuck trading huge products. The products can actually be so big, in fact, that many traders can't even adopt them, even with the lower capital requirements. So the smaller percentage requirements due to span don't necessarily translate to easier access. Another trade-off between futures and stocks comes in the way of futures' greater accuracy in tracking an asset, which has long come at the expense of consistent construction. Now, how can something actually be accurate and inconsistent? Well, I'll show you. The term pure exposure is often referred to when speaking on futures. And all that really means is that a futures product tends to be better at tracking a commodity like gold than a bunch of stocks that deal in the mining business. And this is because futures are directly tied to the index or the commodity, whereas stocks relate to it imperfectly. But because futures become, a little less attractive to traders when we find out that their characteristics vary from contract to contract. And while stocks lose in the pure exposure department, they kind of make up for it in their consistent construction. And many traders, like myself when I first started trading, are willing to give a little in correlation or exposure to trade ETFs or shares that they're more comfortable with. Maybe you experience this by using TLT instead of ZB or USO instead of CL. And finally, futures are much more dynamic than stocks and exchange traded products, but they're also a lot more confusing. This has been a long battle between not enough and too much in the way of distinct markets that could show potential opportunity. These are kind of the broad strokes here. The exposure advantage in futures lends to a great deal more variety that can be seen in stocks. And while the ETFs attempt to emulate the indices that futures directly track, they also just tend to kind of act like stocks. And so the opportunity for traders living only in the stock and ETF market is exclusively tied to opportunities in equities. Whereas with futures, you can span multiple asset classes like metals, foreign exchange, and jump from market to market as movement cycles in and out. You don't have to sit around on your hands waiting for metals to move, for example. You can traverse between energies and rates and foreign exchange. But I think traditional futures take this idea a little too far. Since these products were primarily made for large institutions with very specific needs, the products lack a nice broad simplicity. As an example, the US dollar has been moving around a lot recently, but if you came to your platform with a trade idea for the US dollar, you'd be prompted with several choices in trading its exchange rate, and you may spend more time studying which pair to trade before you actually execute on your idea. At least with stocks, that lack of dynamic nature is made up for with the simpler approach. And this is where the small exchange comes in, guys. The goal here with the smalls is to take all those advantages of futures that you know and love and make more efficient products, pare back the complexity, and add that ease of use that is currently only seen in the stock or ETF world. So there's no more this or that. The smalls were built as a new kind of product that are futures, but they don't necessarily look or feel like it. So the days of pros and cons are behind you. We believe it's time for small, standard, and simple. These are the three pillars that we're counting on to execute our mission of bringing greater accessibility and more people to the market. So we've created products that fit almost any trader's portfolio, require little to no contract specification studying to jump on board, and get you trading across several asset classes as quickly as possible. So let's start with the first pillar of being small. How does small fix both the high capital requirement problem of stocks and the huge size problem of traditional futures? By keeping the size small enough for anyone to adopt and the requirements at a span percentage that maintains an efficient use of your capital. Regardless of whether the market is priced at $1 or 10,000, you will only need to put up a fraction of that amount to trade. And it's usually between 1 and 25%, and that kind of depends on the market. Futures margining is based off a model called SPAN that considers the notional value of the future and some volatility and a bunch of other statistical measures. And this is a huge discount relative to the stock or ETF version of the same market, which if you've traded those products before, you know that you're going to pay half or almost all the product's value to trade it. But take a look at traditional futures here. They aren't the same size as a few shares of Apple or your favorite ETF. I mean, they're usually hundreds of thousands of dollars. And after some number crunching, you can see that these products cost thousands of dollars to trade, and they exhibit thousands of dollars of risk in a few hours' time. The smalls keep that low requirement on your capital by using that span margining, and they add the flexible size not currently available in traditional futures. So this makes for a much more manageable margin value, only demanding a couple $100 to trade. And you still get the efficient potential for large returns that are exclusive to futures. Again, but at a size that gives more people access and even allows larger traders greater flexibility so they can scale up and down very easily in all their trade ideas. So I just want to show you a quick example of a stock market that trades with the size of a traditional future, that's going to be the black line, and compared to the smalls equivalent, that's the red line. The first thing you're probably going to notice when we keep the vertical axis in mind here is the daily swings of thousands of dollars and the longer term changes of tens of thousands of dollars in the traditional future. And then you look at our stock market and see essentially a flat line by comparison. But what's really going on here, this is our small stock 75 equity index future. It's simply a smaller version of the same opportunity. It's a stock product that sees the same movement as the traditional benchmarks, but at a smaller fluctuation in dollars per contract. So instead of moving thousands of dollars per day, we're moving at a pace that is much more adoptable for the everyday trader. So our stock product here, the small stock 75, is moving just over about $100 a day, relative to the thousands of dollars in the traditional futures equivalent. And this characteristic of small futures persists across all the asset classes available to trade at the small exchange. So whether that is equity indexes, precious metals, foreign exchange, interest rates, or the soon-to-be trading oil product, everything will move with a historical daily range of about $100. So much more palatable for traders of all size. And that really allows you to no longer sacrifice the higher potential returns for a more flexible product. Don't be pushed into a product that's too big for you. We want to afford the best of both stocks and futures with small sizes and requirements. So you reduce your size and not your opportunity. The second pillar here is small exchange products are standard. And we've always had to choose when we're trading between accuracy and consistency when looking to implement trade ideas. And it's kind of a weird question, but why would markets like metals require a choice between something that tracks the commodity directly and something that looks like your other portfolio pieces? Until now, you've had to trade either gold stocks or gold futures. The gold futures get you directly to the world of metals. You're as close as you can basically get to the commodity itself with gold futures. And with gold stocks, you're one step further away because you're dealing with companies in the gold business. If you're looking for bars of gold, silver, or platinum, you probably shouldn't be trading an ETF that holds companies with CEOs and departments that rarely come in contact with the hard commodity. I mean, so many of us are pushed outside of the exposure we want because of the legacy size and complexity of traditional futures. When you're looking to add precious metals to your tool bag, you want to gain exposure to precious metals, right? I mean, that's what you're going to the market to do, execute an idea on precious metals. The last thing you want to think you're getting exposure to in gold, silver, and platinum is some random company's extraneous variables like the board of directors or a lawsuit or any of these factors. I mean, imagine if you were looking for gold exposure, which ended 10% up in this time frame, and you were actually an XME and you ended in a negative position, you would be so frustrated. So there's all these obstacles in trying to get exposure with gold when you have to use something like an ETF. So let's get back to our nice view of gold, silver, and platinum, and moving up and down around 10% and showing you exactly what metals prices are. The small precious metals future is going to track this basket of commodities as well as any other product could. So you have no more random moves in your portfolio, not reflecting the market that you actually came to trade. But here's where futures usually lose out. None of us wants to read another table of contract specifications that tell you basically all the things about a market that won't put $1 in your pocket. I mean, it's crazy that you need to study new specs every time you look to enter a new asset class. And honestly, sometimes I even have to study the specs within the same asset class. That's true for stock index futures. That's true for currency futures, energies, and metals, actually. Compare that to small exchange products where we've unified and standardized all of the contract specs. So you spend less time studying and more time trading. Let's take a look here. If you're trading traditional futures and metals, you're going to have to multiply your gains or losses by, in this case, $100. In equities, your prices are fluctuating in quarters and you're multiplying by $50. And when you jump over to foreign exchange, you're moving in, this is a half of a 10,000th of a penny, and you're multiplying by 125,000 euros to calculate your P&L in Forex. I mean, the calculations required to trade across asset classes is just time consuming and totally antiquated. Now, the retail trader is no longer held hostage by the large institution with its specific multipliers. All smalls have one tick increment, one multiplier, and all small exchange products are like this. So everything moves in a penny that equates to $1. No more looking for a trade in gold, only to find that you have to think in dimes that amount to $10. And then moving on to stock markets that move in quarters that equal $12.50 before concluding in Forex that fluctuates in, again, that half of a 10,000th of a penny. One tick, a penny, one value, $1, all small exchange products. And this is a factor here that is often overlooked, but honestly, with pure exposure, we've had to fill our calendars up with events that we don't even want to know are happening. Of course, they're important, but they're just this overburdening, looming threat of physical delivery, right? Like every asset class has its own expiration day, and you're simply at the mercy of it for wanting access to more than just stocks. Well, for the first time now, all small exchange products will expire on the same day of the month. That's the third Friday. And each market will have an expiration every month, so you can forget about which month codes are attributable to which markets. All you have to do is trade the active front month, and that would be as easy as it can get. So we want you to spend your time trading and not studying contract specifications. The third pillar here is that all small exchange products are simple. So when it comes to the amount of context that a product lends to a market, the battle between futures and stocks is one of often too much or not enough. But neither offers clear context that gets you from idea to execution quickly. So as I mentioned in the beginning, futures can give you access to a wide world of financial instruments and commodities, ranging from small nations' currencies to broad oil indexes, whereas stocks kind of just show you, the world of stocks. But how much is too much? When throwing the magnifying glass on an asset class like foreign exchange, for example, you are given several ways to trade the US dollar, all at the expense of another region with its own politics. It's nice to have access to Forex, but having to learn everything about relative exchange rates just to trade dollars is simply too much. You came to the market with a simple trade based on your research on the US dollar. You shouldn't have to learn Japanese and study the Japanese CPI and follow the Bank of Japan on their announcements just to trade the US dollar. It should be more simple than that. So the small exchange is offering simple takes on all the major asset classes, which allows you to trade your ideas without having to be obfuscated by confusing contract specs meant for somebody else. So I just want to give you a quick look at what is available for trading now at the small exchange. To start, we have the small US dollar. It's going to connect you directly to the US dollar while diversifying against the world's 7 largest economies. So you no longer need conversions when trading foreign exchange. You think the dollar is going higher, you buy the product. You think it's going lower, you sell the product. We have the small stock 75, which finds the most dynamic stocks from the 5 major sectors and adjusts with shifts in the equity environment so you stay trading an active stock market. We have the small technology 60, which gives comprehensive access to this tech sector by tracking the most active stocks from information, retail, media, and even biotechnology. So we're seeing movement related to the COVID-19 vaccine. We have the precious metals. The small precious metals combines gold, silver, and platinum. So you trade the developments that matter most in a changing metals market. Now it's mostly gold, It's about 80% gold and moves with about a 0.9 correlation to gold. But we know silver and platinum tend to be the more volatile precious metals. So on days like today, when those are really moving around, you have some excellent opportunity in SPRE. And finally, we have the small 10-year US Treasury yield, which is our newest product and cuts the complexities out of bond pricing and takes you straight to the yield you know. So you can skip the calculations and just trade rates. So the days of making 3 left turns to arrive at your trade destination are long gone. Now you can make 1 right turn with the smalls. In summary, the small exchange is bringing you small products with efficient capital that can be tailored to any account size, standard products with a universal construction that tracks directly, and simple products that provide clear context that accelerates your ideas to executions. So who are the smalls built for? We think these smalls are built for everyone. We put all of our effort into creating futures that are built for new traders looking to try affordable products, existing traders looking to scale trade ideas, and everyone in between. Now, before I wrap up, I do want to spend a few moments and introduce you to our newest small exchange future, the small 10-year US Treasury Yield. Now, it sounds like a mouthful, and for now, since it's the only small interest rate product trading, and we do plan to list shorter and longer durations, you can just call this guy small 10s or small yield or small treasury, but it's the first interest rate future that is actually priced in yield instead of price, which we think is really going to open the door to people trading an asset class that is so omnipresent in our lives, yet so difficult to trade on public markets. So here's a little bit of information on existing futures prices, and I'll show you the corresponding interest rates in just a moment. But if you've ever traded interest rate futures before, you're familiar with this quoting convention here. We'll take the 2-year, for example, and this data is a little stale, but it works for this example. A 2-year price of 110.12. It looks a little different than what you may be used to if you've never traded rates before. And that's because it's not a decimalized quoting convention. This is actually a fractionalized quote. So that 12 there after the apostrophe signifies 12 30-seconds. That's a fractionalized quote. And what's most interesting to me is that this is how we trade interest rate futures now, but we never hear about interest rate futures prices when we turn on CNBC or read the Wall Street Journal or sign up for a mortgage, a car loan, or a student loan. We hear about it in terms of yield. And you'd have to be Jim Simons or Ed Thorpe to convert these treasury bond futures prices into interest rates. I mean, there's hardly a relationship. When I was taking financial mathematics in university, we had to get a special calculator just to derive the interest rate. I would be amazed if any of you could determine the corresponding interest rates to these prices. And we found this to be a huge obstacle in getting people to try interest rate futures. So what we've done is flip the model completely on its head and launch an interest rate future, which for the first time ever is actually quoted in yield. So you've heard stories about 10-year interest rates going to zero. You can look at S10Y and say, wow, would you look at that? The price is actually moving towards zero. This is the on-the-run 10-year Treasury yield, S10Y. We've had a nice bounce, actually, over the last 2 days. We're now above 1%, and that would be reflected in a value here above 10. And I'll show you exactly what I mean by this. A small futures price for US interest rates with a 10-year yield of 87 basis points would equate to a futures price of 8.7. It's as clean as it gets. No more inverse relationship between price and yield. You think rates are going higher, you buy. You think rates are going lower, you sell. Here it is, mirrored against ZB, and I know that ZB is a bond and notes are 10 years, so there's a little different, but I figure most of you are trading bonds if you're trading interest rates, and you can see that mirrored relationship perfectly. As bond prices increase, yields decrease, But you don't need to worry about that anymore. If you think rates are going higher, you buy. You think rates are going lower, you sell. It's as clean as that. It's always the on-the-run 10-year Treasury. What we mean by that is every quarter, the Treasury Department of the United States auctions these securities. We will adjust to the newest CUSIP, the newest Treasury note in play. So you'll always have the closest to the 10-year interest rate, which makes it very clean and very precise for trading purposes. So we wouldn't be the small exchange if we didn't maintain the idea of small products. And I think we've done that quite well here. You can see the notional value of the small 10-year Treasury yield is $900. You compare that to ZB, ZN, ZF, and ZT. Those are the 30-year, 10-year, 5 years, and 2 years, all well over $100,000 in notional. Now, I spoke to the capital efficiency of futures earlier in the presentation. Interest rates in general tend to be one of the best examples of that. We often only have to put down around 1% of the product size in margin requirement to trade interest rate futures. But even 1% on ZB, ZN, ZF, or ZT is well over $1,000. With an S10Y margin, with an S10Y notional of around $1,000, the margin requirement is only around $100, which makes this product extremely flexible for investing, speculating, and hedging, and also very cheap to try. Right now, small exchange transaction fees are the lowest in the business, and our market data is free, as I mentioned. So unlike with ZB, where you're paying about $1.50 per contract trade, you're paying only 15 cents with S10Y. So for those of you thinking, well, the exposure is much greater with bonds, and I want a lower cost product, I think you could scale up accordingly in S10Y, and it would almost still be cheaper. I think it would be cheaper actually on an exposure adjusted basis, which is just great for new traders looking to try rates for the first time, or experienced traders wanting to add another complement to their portfolio. And again, we've maintained the standardization with S10Y. It ticks just like it would if it were a stock or an ETF. And for those of you who want to nerd out a little bit here, this is moving in tenths of a basis point. So you're actually getting a little more wiggle. When rates move, you're going to have more volatility in this interest rate product because it's quoted a little further out. So for example, a 10-year Treasury yield of 1% is a price of 10 in this interest rate product. An increase of a tenth of a basis point would be a $1 move in S10Y. So very consistent across all the other small exchange products as well. Again, I'm listing here the quoting of some of the traditional futures. You have 1/32, a half of a 32nd, a quarter of a 32nd, and an eighth of a 32nd for the 2-year. And you may be thinking that I messed something up on the slides because the dollar amount is the same for the 5-year and the 2-year. To add to the complexity, the 2-year has a double the notional of the 5-year. So that's actually correct. It's just another little nuance that you have to know if you're trading the traditional futures. Hopefully you no longer have to worry about that with S10Y. So to wrap up here, guys, the smalls can be used for a number of purposes. You can speculate on short-term action. They're absolutely fantastic for that. I think many of you listening to this webinar intend to use them in that way. You have no pattern day trading rule, favorable tax advantages, easy to buy or sell. There's no stock loan, etc. But they're also great for investing in long-term direction. If you have a bias in gold and you think that safe haven assets will outperform in the coming year, it's much cheaper to maintain a position in the futures than it would be holding something like GLD, for example. And it's an exposure with smalls that you may be more comfortable with going to sleep at night, not expecting a $20,000 move in a single session. And finally, the smalls are great for hedging. This is one of the most important use cases of the small exchange products. And I think the size lends to that perfectly. You can really fine tune your risk profile, and all of these speculating, investing, and hedging work for any of the small exchange products. I'll show examples for S10Y, but keep in mind the other asset classes I mentioned previously. So starting with speculating, here's just an arbitrary day, Monday, November 9th, and take a look at the high to low range in the S10Y. Right off the bat at market open, rallied 50 ticks, that's $50. And by the end of the day, had sold off another about 50 ticks or $50. This is perfect two-sided scalping opportunity. For a $50 intraday move, I think is palatable for many of us. And if you want to scale up the position, you certainly can do so. But we're seeing a number of opportunities like this across the small exchange markets. We widened that time frame a little bit as well. Now we're looking at daily close data. Since the summer here, we've seen multiple instances of $1 moves. Remember, a $1 move is $100 in all small exchange products. So a lot of intraday opportunity. If you want to hold these overnight, if you're playing a price extreme at the highs or the lows here, several instances for some quick scalps intraday. When it comes to investing, one thing I think is so interesting about the interest rate asset class in general is it's very different from stocks. We've seen a grind higher in stocks over the last, let's call it 13 years or so. Rates move very differently. Rates, what we've seen and what we've tended to kind of notice over the last several months is that there's maybe some kind of mean reversion play here. We've seen a high of 3% in the 10-year Treasury yield, that's 30 in this product, and a low of about 50 basis points or 5 in this product, with an average of around 20 or 2% on the 10-year yield. Could be an interesting mean reversion play here if you're a long-term investor who wants to trade around that 20 handle, maybe sell when you're at 30 or buy when you're at 5. Just one example of how you can really utilize the great potential return on capital with futures in a size that's much more palatable and showing some pretty interesting movement. The same kind of instance here is highlighted when I talk about diversification and hedging. Many of us, if you've spoken with a financial advisor, are familiar with a stock bond portfolio. And this is not my advice by any means, but it just means have some stocks and have some bonds in your portfolio for diversification. Now you can do so in a way that's completely amendable to any portfolio size. If you're trading an account that's $10,000 or $25,000, one of those ZB futures or one of those ZN futures is going to be much too big for your account. You're just going to be over hedging is my assumption. But with a product that has $1,000 in notional, you can really fine tune that hedge and you can take it on, put it on or take it off very easily. You can do it on a short-term basis. Maybe you want to hold it into a FOMC announcement because you're expecting some behavior out of the Federal Reserve. You can certainly add it for the day and take it off the next day. So a lot of ease of use with the smaller size and the standard construction. And do remember that because this is quoted in yield, stocks and yield move in a positive correlation, unlike you may have had to train yourself to remember that bonds and stocks move inversely. So here we're moving in the positive correlation. And finally, that brings me to pairs trading in between the interest rate asset class. Here I've shown some ratios and correlations of the S10Y to some of those existing futures, those bonds, notes, 5s, 2s, and even the TLT ETF here. Of course, they have very strong correlations, very strong negative correlations, meaning they move very similarly. But I've also included the hedge ratios here. So a lot of our market makers who are in the small exchange markets quoting are using some of these ratios for pairs trade, for hedging, for potential ARBs. And I will let you guys know that down the road, we do intend to list other knots on the Treasury curve, perhaps a 2-year, perhaps a 30-year. And when you want to trade a curve, whether that's a knob spread, a notes over bonds, that's 2s and 30s, or maybe a 2s 10 spread or a 230 spread, you will not have to worry about DV01 conversion. If you don't know what that is, don't worry about it anymore. You won't have to. If you do know what that is, you can give a big sigh of relief because all small interest rate products will trade on a one-to-one basis because it is the yield and it is not the price, which is just super exciting for those of you trading, a global macro style or wanting really cool, unique diversification to your portfolio in a whole world of new trading opportunities. So that does it for me today. I do have to plug a few things here at the end. I hope you enjoyed the presentation. Right now, this small exchange is running a fee holiday, an exchange fee holiday on the S10Y futures. So you can try them at any of our participating brokers. We have people connected, including IBKR, Tastyworks, EdgeClear, Gain, and many more. Go to smallexchange.com/brokers to see the full list. We're waiving our 15-cent exchange fee. Some of those brokers are even waiving their commissions. So it's almost never been cheaper to try this product. All you got to do is pay the 2-cent reg fee, which we can't get around. And again, that margin is only around $150. So never been a better time to try futures or to try interest rates. If you find that you love trading the smalls, we do have a subscription offer similar to Futuresio. It's a one-time payment. It's $100, and that's going to afford you a 50% reduction on all small exchange transaction fees and reduced market data fees when and if they go into place for your whole life. And remember, there's no market data fees right now anyway, so you don't have to worry about that. You should be good to go. So that's going to do it for me today. I am going to open it up for questions. Both Dave and myself are here. Feel free to throw your questions in the chat, and we'd love to answer them. Just a reminder as well that IQ Feed free trial sign up link is on the screen. Certainly check that out, and thank you for joining us today.
Awesome. Thank you for the presentation. If you have questions, please feel free to type them into the questions box. If you're watching this afterwards on YouTube, you see the email links and the link there for IQ Feed. Please feel free to check it out. How is the volume and liquidity?
That's a great question, guys, and I applaud you for asking because it's one of the most important factors to consider before placing a trade, right? And when we went live, we're still in our infancy. We went live back in June of last year, June of 2020. The liquidity was a little rough. Many of our market makers were adjusting to new markets. It takes them time to tweak their models and kind of get everything squared away. I'm very excited to say now that the liquidity has tightened up tremendously across the board. If you're looking at those front month contracts, you should be seeing 2 to 3 tick wide markets all day, basically from 8:30 to 3. There's an additional period of trading before and after those hours where it can be a little loose. But for most of the trading day, it's been quite excellent. Just stick to those front month contracts. We're in a roll right now. So these January futures are expiring tomorrow. So your active month is actually going to be February. That's month code G. But it's gotten tremendously better over the last several months. The market makers have really stepped up and it's improved tremendously.
Okay. Do you know of any prop trading firms allowed to trade your products?
Great question. A few, I guess, kind of that come to mind. We've had some great conversations with a firm called T3. They're very close to being a prop shop, kind of that they follow that sim to funded model in offering smalls. Earn to trade, very similar as well. They're connected to the small exchange. I think that probably covers most of the bases here. If you have a prop shop in mind, feel free to reach out to me. My email and phone number are on here. We'd be happy to talk with them and make sure that they can offer the small exchange products. I think they're a great stepping stone for people wanting to try futures and manage their risk accordingly. A little easier to overcome because of the tick normalization and the uniform expirations and the smaller margins. So we'd be happy to talk with any prop shops on listing the smalls.
Okay, he says, I'm using NT8. What is the best and fastest way to go from here?
What is it, NT8?
Yeah, Ninja Trader 8.
Ninja Trader, first thing you should do is shoot them an email and say, hey, I want to trade the smalls. We've had some really excellent conversations with them. They're not offering the smalls currently. If you shoot them a message, that always helps. We're ready and good to go to get them connected. They just need a little pushing. So anything you guys can do on your side would be tremendous, and we hope that they'll be offering the smalls soon.
Okay, he says will do. What type of market breadth is available, if any, by your exchange?
So multiple levels. Of course, the top of book is there, and then there's actually full depth as well. So I believe if you're using DTN, for example, one of their more advanced platforms will show you the full depth. Everything is matched at our exchange. There's no payment for order flow in futures. You're not being routed around across 12 equity exchanges. So everything takes place in our central limit order book, and all those levels should be there available depending on who is providing your market data. I know firms like CQG and Rhythmic are certainly showing the full depth. So if you use one of those providers or DTN, you should be able to see it.
Okay. He says, I'm sorry, I meant breadth, not depth.
Okay, is this, I guess, in reference to multiple expiration?
He says, like the NYSE tick advanced declines.
I think that's going to be contingent on your market data provider. From our side, I know that is disseminated out through our feeds. It's just a matter of the data distributor. So I would check with them, see if you can get it, but I believe it's being published by the small exchange. So if they're aggregating it and pushing it out, you should be good to go.
Okay. I'm not seeing any more questions. I'll give them another minute or so to get some in if they have any.
I can speak to a question as well that was posed by Mike just a few days ago.
Yes.
Someone had mentioned why might someone trade a blended index of metals as opposed to the spot, or how would I hedge something that is a combination? So for example, the US dollar contract is 7 currencies and the precious metals contract is 3 metals. What I can say to that is most of these contracts, for example, in metals, it's moving very similar to gold. So it's about 80% gold in SPRE, and it moves with gold on about a 0.9 correlation. So for hedging purposes, you can use something like an MGC or a GC or a GLD. That'll work quite well. We added the silver and platinum because they tend to move around a bit more than gold. Sometimes you have these days in the markets where gold is unchanged and silver's up 3%. And we wanted to capture some of that movement when we created this proprietary product. So by including a little bit of silver, a little bit of platinum in there, you get more wiggle in the product. But also it creates some really interesting basis trades. You can, and we publish this as well in our newsletter that goes out every Monday. You can see how would you hedge this with silver, or how would you hedge this with platinum. And you can trade a little bit of those deviations from the actual gold correlation. So it creates a very interesting trade. That's true with the FX product as well, which is primarily euro and British pound. So you can use those contracts for hedging purposes. And it creates kind of a fun basis trade if you are pairs trading.
Okay. What is the approximate average volume for the equity index?
Sure. Between the SM75, which is the small stock 75, kind of our broad equity market exposure product, and the STIX, the small technology 60, we're averaging around 600 or 700 contracts a day. That seems small, and we are new, and we do hope to grow this through time. But I think the liquidity there is surprisingly very nice. It's quite tight, both of those markets. Again, the roll is a little interesting right now. Like checking tomorrow, I would look at February as opposed to January and February going forward until the next expiration. Across the whole exchange, we're doing around 2,500 to 3,000 contracts a day. We've grown quite nicely since June, and it's holding in very steady. And we hope to grow that through time as more people kind of check out the markets and we get some more liquidity providers in there and markets continue to shake out and move.
Okay. Do you have a product that follows or images the crude?
It's an excellent question, and it is coming soon. I promise you guys. I know everybody is asking for oil. I'm super excited about it as well. We have a lot of the infrastructure done in the back end. We're getting very close. I know that's a much anticipated product, and I can say that it's coming soon, and it will follow the credo of small, standard, and simple, as do our other products. There's a lot of great stuff in the works, guys. I mentioned that the 10-year interest rate. We also have additional knots on the curve coming soon. We're certainly looking at things like options on top of these futures. If you guys are involved in that, it'll be a very nice, a clean way to hedge and employ a little more strategy in your trading, along with potentially an ag product and all kinds of fun things. So stay tuned. It's another reason to check out the subscription offer because that'll lock in your transaction fees, your reduced transaction fees for all new products going forward as well. So if that's of interest to you, certainly check it out and stay tuned. On social media, we'll be putting a lot of announcements. So Twitter, for example, we're very active. We do a lot of videos and stuff on YouTube. You can check us out there. But we'll let you guys know when oil is coming and all the other exciting new products. So please stay tuned.
When does the $100 lifetime subscription offer expire?
Right now, there is no expiration date. So once you make the one-time purchase, you're locked in for your whole life.
No, I think they're asking when are you going to stop offering that subscription?
Okay. For now we have a few allocated. I think there's enough to go around for now. It won't exist forever, of course. So I'd say sooner is better, but there's no end date quite yet. There's a limited supply, but we're not at the end yet. So
okay. He says, I wanted to ask about better price for group of futures and or stocks. I see the website. Oh, this may be for DTN. It says, I see on the website DTN IQ feed base service is $95 a month. Would there be a scalable data feed price as per data groups?
Can you hear me?
Yes.
It's 95. Yeah, $95 is the base IQ feed rate. And I'm not sure exactly what they're asking, but then on top of that, whenever you add futures, when you add options, when you add various news feeds, Forex data, then there's fees on top of there.
Okay. So that's the base price, and then as you add more data groups, the price increases.
Correct.
Okay. And there's been a couple questions. The webinar will be posted in 24 to 48 hours on the Futuresio website and YouTube. All right, I think that is all the questions. Again, if you're watching this on YouTube afterwards, you see Dave and Michael's email on the screen. You can shoot them an email to ask them your question. Thank you for the webinar this afternoon and for spending some time with us.
Yeah, thanks everybody.
Thank you guys very much.